In today's financial fears segment, which just sounds ominous, the S&P 500 already down 20% during the first 6 months of 2022, marking the worst first half performance in 60 years. And that has obviously investors and consumers wondering what the future might hold for the second half of the year. Also, folks concerned about their 401k. So to give us some insight into the stock market and how to navigate these changes is Motley Fool senior analyst Jason Moser. Once again, Jason, we have the giant financial fears sign here, and then we have our little golden nest egg with our 401ks here in the corner. Before we talk about how we can actually end up in a better place based on what's happening now, what do you see as far as the rest of the year, the next 6 months of financial forecasting?
Yeah, I mean, it remains to be seen. Obviously, it does feel like a lot has been baked into this pessimism at this point. I mean, you're looking at the NASDAQ down almost 30% going into today. The S&P hanging right there in correction territory down around 20%. That's fairly significant. I mean, when you look back historically, go back to 2008. Remember, that was the great financial crisis, really. I mean, the markets were down 36.5% this year. And I would argue that was really something due to fundamental flaws in the market, right? With mortgage-backed securities and ultimately fraud that was going on in the market back then. This doesn't seem to be quite as severe this time around. So it does feel like we have an opportunity to pick things back up. But yeah, it feels like we're still in store for some headwinds, as we know that interest rate policy will continue to go up, and that makes the cost of doing business rise, and inflation doesn't look like it's going to be something that comes back under control anytime really soon.
Yeah, not the friend to a lot of people. You know, the old saying goes, the rich will get richer, and they will, because those who have the means and have the money will put a whole bunch of it into the markets now while it's down, and they'll buy into the 20% discount, and as the markets go back up, they will make more money. For people who might not have the means right now, or maybe they're on a fixed income, or they're living paycheck to paycheck, are there still opportunities to come out ahead?
Yeah, I mean, I'm glad you mentioned that, because you're right. Down markets do represent opportunities. It's difficult at the time because we're all in the same boat here, watching our finances dwindle down, right? They're losing value. And that's something that really kind of plays into this cognitive bias of loss aversion, where for us as individuals, we feel the pain of losing. It's essentially twice as great as the joy of winning, right? Those losses really, really hurt versus when we feel those gains. And so it's worth remembering we're all kind of feeling that together, but I do believe that if folks can figure out a way to hang in there, contribute a little bit more if you can to your retirement these days, because these down markets do represent opportunities. It just takes a little bit of long-term thinking.
You know, I think you nailed it with the psychological aspect of things, because sure, technically we're on the brink of recession when you look at the numbers and the criteria that goes into it to make it official. I think that the pain at the pump just kind of spells it out for most people more than anything that would be official. But you're right. You know, if you go back to anybody who played sports, you probably remember the dropped pass as much as you remember winning the games, you know, and you remember the downside. It sticks with us. So psychologically, how do we get over that hump?
Well, I think one thing to remember is really the facts are on our side here. And what I mean by that is the longer we remain invested, you know, we espouse long-term investing here at The Fool. The longer you remain invested, the fact of the matter is the lower your chances of actually even losing anything at all. And if you just go back to data that's been collected since 1929, and again, I'm talking about the probability of negative returns here. If you look at the S&P back to 1929, every day that you're invested is essentially a coin flip. It's 50-50. But if you draw that out to just 1 year, the probability of actually losing money dwindles down to 25% if you remain invested in the market. Now, if you stretch that out 10 years, any 10-year rolling period since 1929, the probability falls to 6% that you'll actually lose money. And you can imagine if you stretch that timeline out even longer, your probability of losing money essentially disappears. And so really, I know folks out there believe that perhaps investing is too risky. But when you look at the actual fact of the matter, really the greater risk is not investing at all. It really does just take adopting that long-term mindset, which can be difficult during times like these, because as we said, you just feel the pain of those losses greater than you do enjoy those gains.
Real quick on that point, obviously, if somebody jumped in for the first time to investing in December, they're kicking themselves right now, and they're second guessing every decision, right? But if you haven't, if folks out there haven't, would you advise they do now if you're buying at a discount?
Absolutely. I mean, now it is better time than ever, really. I mean, these down markets do present opportunities. And if you just remember, all of these downturns in the market, every single time, 100% of the time, the market has recovered and gone on to set new record highs. It just takes believing, adopting that long-term mentality, making sure you have a diversified portfolio of businesses that you feel like will stand the test of time.
Wishing everybody the best. Jason Mosher, thanks. As always, good to talk to you from Motley Fool. And there's the information if you would like to find out more information about how they do business there. Wisdom?
All right.